Hey, what's up, everybody? Paul Brands with your Fun Day Friday market update. So this weekend in rates for August 9th. So here we are. We are going to talk about a lot of stuff. We're going to talk about the increase in listings and what it really means. We're going to talk about interest rates and the differences between rates, between families. There's so much that goes into an interest rate. It's just not just here's a rate and everybody gets it. So I'm going to shed a little light on that. We're going to talk about what happened in the job market that has created rates to start trickling down. And we're going to look at the most recent appreciation report. So a lot of stuff. What do you say? You and me, we just dive right into this. So let's bring up the active listings. So what I'm going to do is I'm going to take me out of this picture, and I'm going to share with you this shaded line here is the recession that was resulted of COVID. So this was pre-COVID inventory levels. Now you notice how inventory goes down, then back up, then down. It's just you have seasons. There's certain parts of the year that people don't sell. There's just normal trends. So it's very natural or normal for the housing market to have these fluctuations. Now, before we went into COVID, we had about 1.2 million homes for sale. Let's fast forward here to January 2022. The hardest part is we get accustomed, we get used to seeing one for sale sign in a neighborhood. And then all of a sudden, if we see two or three, all of a sudden we want to assume, however, that everyone's selling their houses and values are going to start coming down. But I want you to notice that even as we start to perceive that there is more homes out there and the market is starting to change, the truth is we are still well below pre-COVID numbers in terms of listings. So there's room to go up, which still puts us in a seller's market. Very interesting stuff here. And to me, it is interesting. So I hope that helps you out, put a little bit of light, because what's going to happen as rates start to come down, we still have a supply problem, and that's going to put that upward pressure on interest rates. Speaking of which, or purchase price, speaking of interest rates, I'm going to take me out of the picture again. And what this chart is going to show you here is the impact that credit score and loan to value, or in another way of putting it, how much down you put down will impact your credit score. So let's say, for example, you are a family that has a credit score of 720, between 720 and 739, and your friends are going to go buy a house and they put down more than 20%. Well, they're going to get an interest rate of approximately, this is an average of 6.593. Now, for those putting less than 20% down, there is an increase in perceived risk for the rate. So that rate is going to go up to 6.638. A lot of people wondering, like, why can't I get the same rate? Well, you can, as long as you put the same down payment and you have the same credit score in. But remember, FICO scores, down payment, loan size, loan product, all those play a significant role in your final interest rate. Let's talk a little bit about trends here. I love this because this is what we saw happen from last week, but this also gives you a great idea of a declining market. You see, everybody wants to, maybe not everybody, maybe you don't, maybe I shouldn't judge. Everyone thinks, or most people think, that when in declining markets, rates are going to go down at a steady pace. But that's not true. What they do is they drop two, they go back up one, they drop two, they go back up one. And the trick is people who try to time it at the lowest peak, you guys, it never works. It never works, because what happens is when it hits its bottom and it goes back up, it literally shoots straight up, and you're going to lose your opportunity to refinance or buy at with a great rate. So let me bring that back up here. And nope, not that one, excuse me, this one right here. And this is the trends from last week. I want you to notice here that from July 30th on the Tuesday, rates declined all the way till August 5th. And then what do? They bounce back up. So what happens is by the time the rates hit here, it comes out in the news the next day or two, but it's already too late. The interest rates have already gone up, and you're kind of wondering what happened. Well, now you know about interest rates. All right, Let's go ahead and bring up what the average rates are of the day. You have a 30-year fixed rate at 6.5. VA is in the fives. That is absolutely phenomenal. Jumbo 6.866, USDA 6.332, FHA 6.329, and a 15-year fix 5.5. That is significant improvement from the week before. So what happened? Why did we see interest rates start to decline? Now, we've talked about this on my little mini show here, that the Feds and the bond market are very focused on the unemployment. A weaker employment market is going to be good news for bonds and for 30-year fixed rates. Remember, the stronger the labor market, the more people have to pay for the employees, and that increase in pay is going to be passed on to you through the use of their goods and services, hence inflation. So what we saw is that wages continue to moderate and small businesses are showing job losses. Both are bond friendly and should support future Fed cut rates. This is the break, right, of inflation and heading towards that goal of the Fed's 2% inflation mark. Let's go to pending home sales. The index is at 74.3 month over month. It's up 4.8. Year over year, it's actually down 2.6%. So pending home sales bounced significantly higher in June, although from low levels. So mortgage rates have been improving, and we further anticipate that more homes are going to sell as a result of interest rates starting to decline. Let's talk a little bit here about the actual value of homes. So month over month on a national level, values went up 0.3%, month over month, year over year, 5.9%. We're still seeing, even with rates where they're at, values being supported. Yes, you are seeing home listings that are sitting, and they're also getting a decline in prices. But many of those are just overpriced homes that the seller has false expectations of what they're actually going to get. But here's the deal. As we start rates go down, which we saw last week, I'm seeing more and more buyers coming to get their pre-approvals updated. They're starting to get excited again, which means more competition. That should put an upward pressure on home values. So it's going to be great to be a homeowner. It's going to be tough, even with lower interest rates, to be a home buyer. BLS Jobs Reports. Here we go. We see the unemployment rate starting to creep up to that 4.3%. You know, the truth is the fact is that they were expecting much more, a much higher number of job creation, and they just did not get it. That is also bond-friendly news, or 30-year fixed rates. And again, that's why we're starting to see interest rates start to come down. So we went over a lot of information, my friends. If you were not working together, I think we should. If you want to sit down and just go over your goals, let me answer your questions. There's a QR code right there. Just book an appointment with me. We won't talk about applications, pull your credit. Just utilize my 20 years of experience, and let's put a great plan in place for you. Let's help you save money. Let me teach you how to get the best interest rates. That's my job. I'm very good at it, and I would love to meet you and help you. Paul Obrantz, Clear to Close Mortgage Brokers. Have a great